Welcome to Money Awesomeness. It's part 2 of our tax series, and today we're talking about tax deductions versus tax credits, what they are and how they can help you lower your tax bill. So it's the bare knuckle round between a tax deduction versus a tax credit. A tax deduction will reduce the taxable income, but a tax credit will reduce the taxes owing. And that's a big difference. So let's take a look at a tax deduction. Let's say that you have a gross income of $50,000 a year. And let's say that you have a tax deduction of $5,000 for making a contribution to your RRSP. That means that now your gross income is going to be lowered by that amount to $45,000, which totally lowers your marginal tax rate. And if you watched episode 1 of this series, you know what that means. So most tax credits will reduce the amount of taxes owing by 15% of the eligible amount, and that's the lowest federal tax rate. So let's use an example of somebody who has a transit pass worth $126 a month that's eligible for a tax credit where they live. This means that that person has spent $1,512 of eligible tax credit money that year. Many people think that that $1,512 would be reduced from your income, but now we know that that would be a tax deduction, and this is a tax credit. So that $1,512 of eligible spending money is now multiplied by 15%, which gives us a tax credit of $226.80. So this person's taxes owing are now reduced by $226.80. So now I'm going to give you some often missed tax deductions and tax credits. Financial carrying charges are an often missed deduction, and these are things like safety deposit box fees or investment management fees. If you had to move more than 40 kilometers for your job, you can actually deduct the moving expenses, anything from your transportation and even including your hotel while you were searching for a house. Family expenses can be a goldmine for tax deductions. These are things like spousal support payments, some legal fees for spousal support payments, child daycare, you name it. So you need to sit down with an accountant or a tax professional to make sure that you're maximizing the amount of deductions for your family. And some often missed tax credits are things like charitable donations, and they can go back 5 years. So any of the charitable donations that you've made years ago that you never did anything with, you can use them now. And medical expenses also account for a tax deduction if it's 3% more than your net income. So these are expenses like dental, optometrist, any prescription drugs you had. And I would even go as far to say that if for medical reasons you needed to go to a naturopath or a registered massage therapist, those all count as medical expenses. And lastly, a really rarely used but biggest bang for your buck tax credit is the Canadian political party donation. So if you give money to any of the major parties, you get a massive tax credit for that. Wonder why? So there are way more tax deductions and tax credits than what I just listed there. So make sure that if you're doing your taxes yourself, that you're using software that will actually prompt you and ask you questions to make sure you don't forget any, or that you're using a tax professional that can definitely maximize your return. So make sure that you join me next week for part 3 of our tax series. I'm going to be talking about what happens when you file late. Whether you owe money or don't, there's still negative consequences. So you should subscribe if you were surprised by anything, or if you thought that your family was actually costing you money, but now you realize it could actually be saving you a crap load at tax time.